Hi, I'm Damian with an update on your super and the markets this year. In this video, you'll find out more about how your super did over the past 12 months and what's been happening with the markets. I'll talk about our investment strategy and also the road ahead, what we expect over the coming months. It's been a positive year for most members and their super balances. Most of our members, under the age of 56, have their money invested in our Future Saver High Growth option, which has returned approximately 10.7% for the year. We're really pleased with this double-digit return, which is above the long-term average of 9% over the past 10 years. Meanwhile, members in our most popular retirement income account option, the Conservative Balanced option, saw returns of approximately 7.6% for the year, which is also above the average annual return for this option. Although a little lower in comparison to the High Growth option, it reflects the approach our retired members prefer to take towards risk. The Conservative Balanced option is designed so that when share markets fall, it falls by less, which generally means smoother, more stable returns. While these results are great, it's the long-term returns that have the most impact on your super and lifestyle after work. But let me explain a bit more why this is. Your returns will differ month to month and year to year. Although this can be really unsettling, it's a perfectly normal part of investing. Here you can see exactly that. While this shows our high growth option, many of our investment options see similar cycles. What matters most is how short-term returns even out over time. This dotted line shows how the average return remains positive. To put this into perspective, if you'd invested $50,000 in July 2013 and stayed invested in the high growth option, your savings would now be worth over $121,000. While it may seem counterintuitive, it can actually make sense to add more money to your super during market downturns. That's because when markets and share prices fall, you can buy more for your money. As markets recover, the value of your investments will go up. This makes it one of the smartest things you can do to get ahead in future. Last year in 2022, there were a few headlines that probably caught your attention. These include ongoing geopolitical tensions, particularly the war in Ukraine. There was also rising inflation as we emerged from COVID-19 lockdowns, where I'm sure you've noticed the cost of things like food, gas and electricity all going up. Meanwhile, interest rates have also been rising as central banks try to control this inflation. These issues cause some market uncertainty as we started the new financial year in July 2022. You can see that uncertainty in this chart, which tracks the MSCI World Index. This shows how a broad range of large and medium-sized companies performed across 23 different countries. Around September, you'll notice that markets dropped quite quickly. This was in part because investors were still uncertain about the economic outlook and how much interest rates would need to rise. You might remember that during COVID, central banks, including the Reserve Bank of Australia, had talked about interest rates being on hold for the long term, even until 2024. So the changing environment in which interest rates were rising rapidly caused markets to react negatively. But as investors began to focus more on an eventual, sustained pause in interest rates, we saw an overall rise in global markets. This is a normal part of investing, and we expect markets to go up and down over time. You can see that, generally, this financial year has been good news, with markets recovering over the past 9 months. Most members will have seen an increase in their retirement nest egg as a result. One of the best ways to see your super grow over time is to invest in a good variety of quality assets, which is exactly what we do. Our team of specialists focus on building portfolios that they believe are likely to keep doing well in future, aiming to ride out any short-term market blips. And because these portfolios are so well diversified, when markets fall, our members in these diversified options tend to lose less than the headlines suggest. You've probably heard of people making the switch to cash in uncertain times. But usually the best course of action is to remember your long-term goals for retirement and stay invested. Often members are unsure of when to switch back and so leave their savings in cash. This means you will lock in your losses and miss out when markets rebound and start to rise. In these charts you can see the impact this has on your super balance over time. Here we show the returns for our high growth and conservative balanced options compared to how cash performed. In both of these examples, you would have been better off staying invested in one of these diversified options and riding out the market downturns. As most of our members have time to wait out downturns, even when they're retired, switching to cash is usually not the best way forward. But if you'd like reassurance, we have friendly experts who can help. so talk to us before you make any changes. As the saying goes, it's your time in the market, not timing the market, that counts. Trying to invest just before prices rise or selling just before they fall is not only nearly impossible, it's also not as effective as investing for the long term. For instance, things that performed poorly in the past year can have a great year the next. At Aware Super, investments that didn't perform as well in 2022 were good performers for us this year, like our investment in international shares, and our preference for growth shares, which have been winning off the back of the tech sector's recent resurgence. While we always consider how current events might affect our investments in future, we don't overreact to short-term noise. Looking ahead, there are some key things we're monitoring. We're seeing signs of inflation coming down, and over time we should see interest rates control this further. But goods and services like housing, education and healthcare that prove slower to steady in price could see inflation continue. So we might still see some rate rises over the next year. We know a slowdown in the economy is coming. That's the intended goal of the central banks as they try to curb inflation. The question now being asked is, how slow will it get? In other words, will it be a mild recession or a deeper one? What we do know is that we're one of Australia's largest profit for member funds. And this puts us in an extremely fortunate position where even in downturns, we are well placed to continue sourcing and investing in the best opportunities for your retirement. Let's take a look back at what we've covered. The performance of our high growth and conservative balanced options, the positive year in markets despite ongoing geopolitical tensions, rising inflation and interest rates, the value of diversification and how it can help when markets fall, why timing the market is nearly impossible and not as effective as investing for the long term, and finally, signs of a slowing economy. If you want to understand your super better or find out more about how markets work, you can head to our website or sign up for one of our webinars. You can also book in to speak to one of our friendly experts or chat to your existing planner to make sure your super is on track.